Hey, today we're going to talk about the problems, ending with what we think are the solutions in the industry with being an insurance agent, with trying to find the best career path, with serving the public. I've had the benefit the last 17 years of seeing through the eyes of a lot of giants of the industry, people who have been in it for 40 years plus, and then myself having access to a really diverse set of other designs and people, and spending a lot of time with people who have spent anywhere from a few months to many years in all the different types of designs that you can land in the insurance industry. So with that said, let's get started. There are two major poles in design in the insurance industry on where you land. In the middle, there's the phone jockeys, and we'll get to that. But otherwise, there's the career or captive, or I'll call branded agents from here on out. And then there's the brokers. I'll start with the captive agents. What does captive mean? It means that your contract is captive. You work for a brand. That is State Farm. That is Northwestern Mutual. That is New York Life. These are all wonderful companies, and they often are. Their benefits include that they have brand recognition. They've been around for a long time. Consumers, even though they've never talked to someone from that company, even if they haven't talked to them, they still recognize them. Because they've been around for so long, because they're well-heeled and experienced, they tend to have good systems. And usually they have good mentorship. That's supposed to be one of their greatest value propositions, is you have a brick and mortar presence, you have an organization that pays for an enormous amount of your overhead, and you have systems and a human being who takes you by the hand, and the two of you have a good mentorship experience. You have some simplicity in a tight range of products that you offer. I call that the upside. The downside is that you have a tight range of products that you offer. You ride for the brand. You're not like the brokers. You don't select among a whole bunch of different companies. You have your company. That's not bad, but it does mean that you can find yourself feeling like you're trying to fit a square peg in a round hole sometimes with a consumer, or you're in a corner, or you just lose the business. You're just not competitive as many situations as sometimes you might like. That also means that when it comes to renewal business, passive income from policies that last over years, you are in jeopardy of being more likely to lose that business to brokers who have the advantage of selecting among anywhere from a dozen to hundreds of other insurance companies, where you have your one, maybe two if they have a little partner for a branch of the business. Still, you're kind of in a corner. The company also owns your contract. A lot of people come into this business because they like the idea of being 1099, have a lot of freedom with their business. But with the captive model, you lose a lot of that flexibility, freedom of movement. My father did a great job in the captive industry for three wonderful companies. But each time there was a not so wonderful part where he got rug pulled. He built a wonderful, fantastic organization, and people were doing well with their careers. And despite that, things that were worldwide operations and decisions that had nothing to do with them or his people, rug pulled them and upended their careers. That's the captive experience. a more fragile career, more susceptible to the corporate decision making, and renewals, passive income that are subject to loss compared to brokers. Also, you don't get paid as much as most brokers today. So there's something to be desired on that side. Now we come to the other side. Let's talk about the brokers. Now on there it says FMO. And FMO means field marketing organization. They're often also called IMOs, insurance marketing organizations. And these are what I call contract collectors in the sky. And they collect usually thousands and thousands of agents across the United States that they contract through them to access multiple insurance carriers. So that's a positive, is you can access anywhere from a dozen to several hundred different insurance carriers, making it quite competitive. A lot of flexibility there. If an insurance carrier has a rate increase, or they get rid of a product line, or any other negative decision, you get to switch. You can help your clients switch if they need to. You can just switch to a different company because there's 9 others just like them. So it gives a lot of career flexibility and stability because you're not beholden to any one particular insurance carrier. We also like the fact that I think we sleep better at night, at least we feel that way, because we can select and cherry pick the very best thing for each one of our clients each time among an enormous segment, if not just about the entire market. You get paid better. The compensation tends to be higher for the exact same kinds of products and solutions. So that's a big bonus. Because you're competitive, your renewals should be stronger. As long as it's done right, your renewals should be much stronger. What's the downside of the brokerage experience, though? The vast majority of these IMOs, FMOs are really, really light to almost non-existent on training, support, real mentorship. Their version of training and support is a monthly PowerPoint presentation online. It's someone who's a phone call away. Either way, it's nowhere near someone who lives, works in the same place you do, and is doing the same thing you're doing in the same time zone and the same city out of the same office daily with you. For that reason, even though your typical broker gets paid twice as much as your typical brand captive agent, the failure rate of first-year agents that are brokers, who should be more competitive and better paid and have a better experience because of those things, have a higher first-year failure rate than captive agents. That's because that support matters a lot in this industry. Systems are light, although they're getting better. Technology is getting better and better for brokers, but they still tend to be lighter than what you're going to find in the captive industry. So now in the middle, on the last 10, 15 years, we've seen what I call the phone jockeys really grow and become a very significant part of the life and health insurance industry in particular. I'll be honest, I'm not fond of it. I know for a fact that there are state departments of insurance that will name phone sales of Medicare insurance purchases as the #1 source of consumer complaints. I know that insurance agents will get a substantial amount of chargebacks. This is when you sell a policy and within the first year the policy dies and you don't get the commission, or you get a chargeback and you have to pay back a portion or even all of the commission. That's no fun. Okay, so it has a higher rate of bad outcomes for the consumer, who more often than not cannot get in touch with the agent who originally sold it to them. Often the agent isn't even allowed to call the consumer back. Even if they are, it's not the same experience. The agent doesn't have the same in-touchedness with the, if that's a word, with the consumer. Often because they're phone sales, their hands are tied a little bit. They can't be as broad a broker with as many carriers. There's just a lot of things missing from the relationship. And so a broker who lives locally and visits a person in person will come out with far more optimal results and a better relationship. And naturally, because they're sitting in their own home or they're sitting in their office with the client, know more about that client, see more touch points, and have better outcomes. And the client knows who they're dealing with, knows how to get back in touch with them to answer questions, get things resolved, instead of just getting very frustrated, filing complaints, dropping policies, and having a poor experience for everybody involved. So I'm not a fan of phone sales. The idea that you can sit in your underwear and call all sorts of states and people and sell over the phone, you have a lower level of responsibility. So that can be attractive to folks, but I'll tell you, it's extremely grindy. The folks that I know that have had marginal to good success at it spend a lot of money every single week on a ton of leads. They grind through them. They'll spend maybe $1,000 to $3,000 on leads, get about $6,000, $7,000 in commissions, and then they'll see anywhere from 30%, if they're really good, to 60% of that business drop off in chargebacks over the following 12 months. That's not a good experience, in my opinion. So that's the brand or captive model, the typical broker FMO model, and this new phone sales model that has become quite popular because I think a lot of these FMOs, they've been around under this model for so long. I don't think most of them know how to create a true agency system anymore. Now, because of all of this, at the bottom you can see two statistics. Retention rate. That is the success rate of insurance agents within their first year. 8 to 20. Across the industry overall, you'll hear between 8 to 11% is the typical success rate. That means about 90% of people fail in the first year. Now, I have also heard it from the horse's mouth. I've been in a meeting of several dozen of the largest, most successful brokerages in the United States, and they over and over again noted in this meeting that their biggest challenge was that they consistently have an 80% turnover rate of their agents, not just first-year agents, their entire agency force year after year. They kept, each of them kept quoting about that same number, 80%. That's not great. That's terrible. The other number listed below, 20 to 60% loss ratio. So this is how much of your business falls off the books and then typically generates a chargeback where you have to pay back a portion of or even all of the commission back to the insurance carrier. And these models typically generate between 20 to even a 60% chargeback rate. 20 is really good. I don't know about you, I'm not interested in that model. It sounds terrible to me. So the consumer experience, let's focus on that for a minute. That's the agent experience. The consumer doesn't get a very good result either under these models. Often the agent can't be reached because agents fail. So many agents are being turned over. 80 to 90% of agents are being turned over. That means they're not, even if they could have been contactable, if they're not in the business, then it doesn't matter. So consumers are not able to get in touch with the same agent, and they're not always getting the experience they want from straight to the insurance carrier when they do that. In fact, there's tons of different statistics and surveys of consumers and how they feel about their insurance out there. And they unanimously have a very distinct data point. The number one thing that consumers want and the number one frustration, they're both almost identical. They want a person that they can reach out to that's not just calling the administrators at the insurance company, but they want an intermediary that they can trust to figure things out for them, to connect the dots, to just be there for them. They want that more than they want even their medical professionals. They want their insurance agent when it's involved. So not optimal outcomes if the insurance agents can't maintain a career. You end up with high pressure sales often if you have a limited number of insurance carriers. The phone sales are similar. It's just the nature of that game. You have confused clients, confused consumers, which is no good, and just bad outcomes because you don't understand each other. Again, especially with the phone-based sales. Okay, so what's the solution? Obviously, I think we're the solution. I had the dumb luck to roll into this particular model. It's a hybrid model about 17 years ago, created by some very well experienced and I think visionary men who put this thing together. And our little piece of that pie has gone from a hole in the wall 17, 18 years ago to what we are today, covering a good piece of the Western United States. And it's been a great blessing. So it's all blue, okay? So you get optimal outcomes for the client because you're there in person and you're reachable, you understand them, and you have tons and tons of carrier and product options. You will always win at the kitchen table. You will always be able to do the best job for each person. You're incredibly competitive. You get real mentorship because you're working out of an office day to day with other people who are there and assigned mentors who care a lot about your success. You have comprehensive support, which we could do a video lasting forever about that alone. You have a strong marketing partner who is really leaning into you to make sure that you're in households and you're reaching out to households who really have a real genuine interest in what you have to offer. You get paid well, you have a resilient and flexible career, and we are designed around very strong renewals, strong relationships, and doing the right kind of business. Because of that, our retention rate is unbelievably high. That's depending on the year you look at. Our last year is very much on the high side, about 90%. Some of our worst years will get as low as 60%. But we're not perfect. We're always trying to do a good job. But I'm really proud of our retention rate, and that our loss ratios they're healthy because we do good business. So that's the problem. I think we're the solution. It's been a great experience, and feel free to take a look at the other videos here.